For decades, these two lines moved in opposite directions. It was a golden rule of finance. The yellow line is gold prices. The other is real yields. If we invert the black line, the correlation becomes even clearer. The relationship was simple. When real yields went up, holding gold, which pays zero interest, was a relatively bad deal, so gold's price fell. When real yields fell, gold was more attractive as a store of value and its price soared. Then, in 2022, something broke. Real yields rose and remained high, and instead of gold prices falling, they ran up one of the most significant gold rallies in history, blasting past $4,000 an ounce. This shouldn't be happening, and it tells us that something significant has shifted in the way investors are thinking about risk and reward in today's economy. By any traditional metric, gold looks overextended. Overlay a trend line and standard deviations on gold's price, and it's quite clear that gold prices are significantly above what would be expected. At over $4,000 an ounce, gold prices are more than 5 standard deviations above the trend line. Such a deviation is cause for pause and concern. As JP Morgan Chase CEO Jamie Dimon puts it bluntly, gold is in bubble territory. Statistically, a move this sharp is a 1 in a million event. It's a parabolic surge, and the traditional drivers are nowhere to be found. Look at demand. Historically, most demand for gold is driven by two main sources: jewelry manufacturing and investment. But jewelry demand is actually down over the past 3 years or so, as you can see on this chart. Investment demand, on the other hand, has seen a sharp jump since the beginning of 2024, more than doubling as investors pile on to take advantage of the rally in gold's price. So this is not surprising, and it would explain some of gold's price surge. But the current gold rally began before investment demand surged. The investment demand came from the rally, after all. There must be another cause, and there is. Central banks have been hoarding gold at unprecedented levels over the past few years, rising from an average of around 100 tons per quarter before the pandemic to a recent average of at least 4 times that. It started in 2022 after Russia invaded Ukraine, resulting in widespread sanctions and the freezing of Russian assets by the West. That event sent a shockwave through every government finance ministry on Earth. It proved that your dollar and euro reserves aren't truly yours if they're held in another country's system. They can be seized. Gold held in your own vault has no counterparty. It cannot be sanctioned, frozen, or defaulted on. So countries like China, India, and Russia are buying gold at the fastest pace in history. This chart shows China's gold stock level since 2009. Notice the explosive growth in gold stocks beginning in 2024 and skyrocketing earlier this year. In fact, it looks likely that global central banks could soon hold more gold than US dollars, as you can see on this chart. This isn't an investment, it's de-dollarization. It's a global rush to acquire a neutral reserve asset. The old rules that said gold should be $2,000 are dead. The new buyers, central banks, provide a massive new floor for the price. A short-term correction is always possible, but as long as geopolitical tensions are high, any dip could be bought up by a government. And there's still room for central banks to fill their vaults more. China, the biggest buyer, still holds less than 10% of its reserves in gold. The global average is over 20%. If they just try to catch up, that could mean thousands of tons of new demand. The most alarming part is what this might mean for the stock market. The breakdown between gold and real yields could be a warning sign for the whole economy. Think about it. High real yields mean borrowing is expensive, mortgages are high, and financial conditions are tight. This is a headwind for the economy and bad for stocks. High gold prices mean the world is pricing in massive risk, geopolitical conflict, out of control government debt, and a loss of faith in flat currencies. This is also bad for stocks. It looks as if we're in a no-win environment. Investors are demanding higher interest to hold US debt, hence high yields, while simultaneously paying a record high premium for gold to hedge against that very same debt. We've seen a moment like this once before, the 1970s. Back then, the rules of money were rewritten when the US left the gold standard. The old models broke, and gold went on a nearly 2,000% tear as the world scrambled for a new anchor of value. We're in a similar regime change today, but this time it's not about inflation. It's about a multipolar world and the slow end of the dollar-based system. By some measures, gold prices do appear overextended. If geopolitical tensions simmer down, or if central banks and investors begin to cash in on the historically high price of gold, we could see these sky-high prices begin to fall back to earth. However, if the US debt situation remains bad or worsens, and as more foreign governments pull away from the dollar, gold could remain a preferred neutral asset. That could rally gold further, or it could put a higher floor under gold's price. So even if the current euphoria fades and prices fall, they may not recede to where they were before. At Capital.com, we'll keep you posted on the latest moves in gold prices. Hit like and subscribe to stay tuned. Thanks for watching.